Alright, so let's talk about Fiverr. They just reported earnings. At the time of making this video, the stock is down around 12% or so. Now, this quarter was actually, in my eyes, a pretty good quarter. We're going to have a look at those numbers. They did reduce guidance quite significantly, but that's because of, well, the whole macro environment basically changed since the last time they reported earnings. So there is some justifications there, but overall the business is still doing well, as you will see with the numbers. So to me, nothing really to be worried about. So let's have a quick look, shall we? So first, as always, the highlights of the quarter. We're going to look at the numbers, obviously, but the one I want to touch on is the AI audition one. It's a new feature, new category that they added, and it's pretty cool. So this allows buyers to input their text and listen to a sample narration from a voiceover seller instantaneously, all powered by artificial intelligence. Basically, you write something, you look at a gig, you write something, then you press play and you see if you like the sound of that. If you do, you go forward and you buy. This will help everyone that wants to make videos, TV advertising, maybe podcast stuff very easily. They talk about the guidance update. They provided Q2 2022 guidance and updated for full year guidance to reflect the wider range of potential outcomes in the uncertain macro environment. So as for the results for this quarter, so they expected revenue to come at the midpoint of $86 million. They beat it by just a little bit, $86.7 million, still growing 27% year over year. And as for adjusted Ebitda, they expected it to come in between $1.5 to $3.5 million. They beat it quite comfortably. As for active buyers, it didn't grow quarter over quarter, but year over year it's up 11% to 4.2 million. Spend per buyer did grow 17% year over year and reached $251. Last quarter that was $242. The take rate also increased a little bit, 29.6%. Last quarter that was 29.2%, quite nice there, still extremely high, which is great for the business, right? Gross margin GAAP 80.4%, non-GAAP 83.5%, no significant change there. GAAP net loss of $17 million and then adjusted EBITDA margin of 4.5%. And now for the full year outlook. So you can see this was their prior guidance. They expected 26% at the midpoint year over year growth. Now that's quite a little decrease here. They expect 19% year over year growth. And as for adjusted EBITDA, they expect it to come between $10 to $17 million instead of $27 or $33 million. As for Q2, they expect to grow at 15% year over year midpoint, and then adjusted EBITDA to come at $3.5 million at the midpoint as well. So as you can see, this quarter was a good quarter, right? They beat their own estimates, but the problem here is guidance. Maybe Q2 looks a bit weak, and then for the full year guidance, obviously they made some changes because of what's happening around the world right now. To me, this is just taking precaution. Maybe they'll beat it, maybe they'll meet it, but I'm fairly sure they won't miss their own guidance. As you've seen last year, they did manage to do quite well on their own expectations. So to me, this is just them preparing for what could become maybe worse or maybe could become even better. We're going to see in the next coming quarter. Again, it's extremely important that management stays up to date and we, the shareholders, are up to date as well with regards to their own expectations. Now, before we continue and look at the further numbers, I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 free stock picks from their popular product, Stock Advisor. Now, Stock Advisor has beat the market by more than 4x. So all you have to do is go to fool.com/couchinvestor to get your free 10 stock picks now. All right, and now the chart that basically shows us how well their marketing investments are. So they say here that the Q1 2017 quarter has reached 5x LTV to CAC. And for quarters that they acquired at the beginning of COVID, those LTV to CAC are reaching 3x already in just 3 years. The increasing spending can also be seen with obviously the spend per buyer, but they say here as well that high value buyers, those with annual spend per buyer of over $500, contributed to 64% of core marketplace revenue in Q1 2022, up from 63% last quarter and 59% in Q1 2021. We know that Fiverr business, Fiverr going up market, is extremely young if you compare it to the likes of Upwork, for example. So it's nice to see that this improves quarter over quarter. And now some more visualization here, right? So you can see quite a nice uptrend here. They say here that revenue during the quarter continued to be highly diversified, with no buyer contributing more than 1% of revenue and no single category accounting for more than 15% of total revenue on the core marketplace. And you can see the same trend here for active buyers and spend per buyer. Yes, active buyers has maybe not increased as much as during the peak COVID period, but spend per buyer has been increasing quite nicely, and this is extremely important. The more people spend on their platform, the more revenue they generate, the better it is for us. As for the take rate, like I said, it's as high as I've seen in the industry, and there's really no sign of them cutting on those take rate percentages. So that's fine for now. Maybe in the future they might cut it a little bit, but that will be when the business will be a bit more mature, I believe. As for gross profit and margin, that decreased a bit year over year due to customer support investments, but they continue to enjoy strong gross margin with an attractive business model. And as for operating expenses, you can see that it still sits around 20%. To me, that's good enough. As for sales and marketing, non-GAAP as percentage of revenue, it actually decreased year over year. They say here that the large improvements in S&M as a percentage of revenue was due to the significant growth in revenue and continued diversification and optimization across their marketing channels. Again, they're extremely efficient as a company. And as for net loss and adjusted Ebitda, so net loss for this quarter was $17 million compared to $17.8 million same quarter last year. Adjusted Ebitda was $3.9 million or 4.5% of revenue in this quarter compared to negative 0.7 million or a negative 1% in the same quarter last year. The improved EBITDA margin was driven by increased revenue scale and improved leverage in operating expenses. And they actually continue by saying that they still expect to reach their adjusted EBITDA margin target of 25% in the long-term future. So overall, to conclude, good quarter, guidance has been adjusted to reflect the current market environment. We're going to see in the next coming quarter whether they can beat or meet their own expectations. But as of now, the business is doing what it should be doing. Management is doing what it should be doing as well. So there's really no need to panic here. Yes, the stock price, the market is doing its own thing, but as long as the business is doing well, I'm happy with that. Now do share your thoughts on Fiverr's current quarter down in the comments below. If you enjoy this type of videos, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button. Maybe check out those two videos here as well. And I see you all in the next video. Bye bye.